We all know this scenario. You need a car, you find the perfect one, and then you hit that wall,
The credit score.
the credit score. Suddenly, all those ads for low-interest loans just, they don't apply to you. It's like they're not even meant for you.
That's the reality of the credit divide. For a lot of people whose credit has taken a hit, or maybe they just haven't had time to build one, the traditional banks just see them as too much of a risk.
Which forces them to look for other ways to get a car.
Exactly.
And that search often leads them right to a rent-to-own, or RTO, car dealer. And that's our mission for this deep dive.
Right? We're going to unpack how these programs really work.
We're using the source material you've pulled to look at the true costs, the terms, and really what you need to know before you sign anything. We're comparing RTO against things like subprime loans and even leasing.
And we have to start with the context, which is just how punishing a low credit score can be when it comes to financing. Lenders price for risk.
The more risk, the higher the price.
Precisely. And that translates into thousands and thousands of extra dollars over the life of a loan.
Okay, let's use that hypothetical example we sourced because I think this really drives the point home. Let's say it's a 5-year loan for a $20,000 car.
Okay. So if you have excellent credit, you might get a rate of, say, 4%.
Pretty good.
Your monthly payment is manageable, around $255. Over those 5 years, the total interest you pay is just over $2,000.
$2,000. That's the best case scenario.
That's the efficient way to finance a car.
No, let's put someone with, let's say, challenging credit in that exact same car, same $20,000 price.
Their rate might jump to 15%.
Wow.
And that monthly payment shoots up to almost $476.
That's over $220 more every single month.
Yeah, and here's the staggering part, the total interest paid. It's not $2,000, it's a whopping $8,547.
Over $6,000 more, just as a penalty for having a bad score.
That $6,000 wall is what pushes people to look for an alternative, and that alternative is often RTO.
So for anyone listening who hasn't run into this, what exactly is rent-to-own?
Well, simply put, it's an agreement where you rent a vehicle, but you have the option to buy it over time.
Okay.
A part of every payment you make goes towards the final purchase price. So you're renting, but you're renting toward ownership.
And the real hook, the reason it's so appealing, is how you get in the door.
Yes. The game changer is that RTO typically requires no credit check.
None at all.
That's the core difference. Even a subprime loan requires a credit pull. But RTO dealers, they mainly just want to see proof of identity, where you live, and crucially, that you have a steady income.
So they care about your ability to pay today, not what happened 5 years ago.
Exactly.
Okay, so let's get into the mechanics. You're approved. What happens next? What does the payment structure look like?
Well, it starts with a down payment, like most car deals. The amount can vary a lot, depending on the car and the dealer. But the first big difference you'll notice is how often you pay.
I saw this in the sources. It's not the monthly payment we're all used to. It's weekly or bi-weekly.
It is, and that's a deliberate part of the dealer's risk management.
How so?
It aligns with most people's paychecks, so the payment amount seems smaller and easier to manage. But more importantly for the dealer, if you miss a weekly payment, they know there's a problem within 7 days, not 30.
It gives them a much shorter leash, so to speak.
A much shorter leash. And remember, these dealers are selling used cars, often with higher mileage, specifically to this subprime market.
Which brings us to the actual cost of the car itself. This is critical.
It's the most important part. The source material is very clear on this. These cars are sold at a significant markup.
Meaning they're overpriced from the start.
Massively. That marked up price is the foundation for the whole rental contract. It's how they make up for the risk of skipping that credit check.
So if a car's fair market value is, say, $15,000, they might price it at $22,000 on the RTO contract.
That's a very realistic example, yes. And your payments are chipping away at that much higher number.
And you're usually paying the dealership directly, right?
Yep.
So you have to keep that rhythm because a $25 late fee, that adds up fast with weekly payments.
It really does. But the goal, the light at the end of the tunnel, is ownership. Unlike a lease where you just give the car back, RTO is supposed to end with you owning the vehicle.
That's the big psychological pull.
It is. But now we have to get into the trade-offs, because this is where you really need to think about whether the convenience is worth the cost.
Let's start with the pros. What are the main benefits?
Number one, the most obvious one, is no credit check. that easy qualification.
The door is open.
The door is open. Second is that path to ownership. And third, and this is a big marketing point, is that they say there's no interest.
Okay, I have to jump in on that one. No interest. If the dealer marked the car up by $7,000, isn't that markup just hidden interest?
That is the perfect way to look at it. Legally, you're right. It's not an interest rate on a loan. It's a rental agreement.
But functionally,
Functionally, the dealer's profit, which is their compensation for risk, is just baked into that inflated price and the fees. You're still paying a huge premium, and that premium can often be more than what you'd pay with a high-interest subprime loan.
which makes the downside much clearer. Let's talk about the biggest cons.
Okay, the first is what we just discussed, the overpriced cars. You're paying way too much for an older, likely high-mileage asset.
Right.
But the second, and this one can be financially devastating, is the lack of warranty.
This is huge. A normal used car might come with a 30-day warranty, or you can buy an extended one. What do RTO contracts offer?
Almost always nothing. The contract usually states there is no warranty at all.
So you drive off the lot, the transmission goes out a week later.
The entire repair bill is your responsibility, and you still have to make those high-frequency payments on a car that doesn't work.
That is a potential financial trap. It could ruin someone.
It absolutely could. Which brings us to what you have to look for in the fine print.
Okay, what are the key things?
Two things. First, check the payment allocation. You need to know exactly how much of your payment is going towards the car's price versus how much is just a pure rental fee for the dealer.
So you want to make sure your money is actually buying the car, not just renting it forever.
Exactly. And second, look at the early termination clause. What happens if you can't make the payments?
You lose everything, I assume.
You lose your down payment, and every dollar you paid toward the purchase price, the dealer just takes the car back, and you walk away with nothing to show for it.
Before we compare it to the other options, there was one interesting positive point in the source material. Can you use an RTO agreement to actually build your credit back up?
You can, but you have to be proactive about it. The dealer isn't required to report your payments to the credit bureaus.
So you have to ask them to.
You have to ask them. Ask them directly. Do you report my on-time payments to Experian, to TransUnion? If they do, then every single on-time payment is a step toward rebuilding your credit and getting out of this expensive cycle.
That's a fantastic takeaway. Okay, let's get to the main event. RTO versus the other options for someone with bad credit. Subprime loans and leasing.
All right, RTO is the easiest to qualify for. We've established that.
Right, no credit check.
Now, a subprime loan. With that, you get the money, you own the car right away, but you're paying that 15% interest rate we talked about.
So you're paying that massive $8,500 interest cost, but you own the asset from day one.
Correct. The downside is you have to pass a credit check. If your score is too low, you might not get approved at all.
Okay, what about leasing? People always say leasing has the lowest monthly payments.
It often does, because with a lease, you're not paying for the whole car. You're just paying for its depreciation, how much value it loses, plus interest and fees. And you can get a new car every few years.
But again, there's that credit check barrier.
Absolutely. The leasing company will run your credit. If it's bad, they might just say no, or they'll hit you with a really high money factor, which is just leasing's term for an interest rate.
So you have three flawed, expensive paths. The subprime loan with its huge interest cost, leasing, which you might not qualify for, and RTO with its inflated price and high risk.
And the critical action for you, the listener, is to shop all three if you can.
Don't just assume RTO is the only way.
Never assume. Get a quote for a subprime loan. See what the total interest cost would be. Then compare that to the markup on the RTO car. See if you can even get a lease quote. The best choice is just the one that costs you the least amount of money and poses the least risk to your finances.
That comparison shopping itself is power.
It is. So to sort of wrap this all up, RTO agreements are a viable gateway to owning a car if you literally can't get other credit. But that access has a very high price, usually much higher than even a bad subprime loan because of those dealer markups.
And before you even consider it, you have to do a really honest assessment of your budget. That monthly payment schedule is unforgiving. If your income fluctuates at all, you could be in trouble very, very quickly.
And that leads us to the final thought, the big question you have to ask yourself. Given that these RTO cars are overpriced and almost never come with a warranty,
Right.
is the immediate benefit of skipping a credit check worth the incredible financial risk of buying an overpriced car that could break down tomorrow, leaving you with thousands in repair bills on top of your weekly payments? That's the trade-off. That is the entire rent-to-own proposition in a nutshell.